just one Chongqing, this is a market we think is grossly overbuilt. So in other research, we've done the same change in supply, change in demand calculation. Chongqing looks like it's supplied 75% more units than it needs. Now, you haven't seen a price collapse in Chongqing, but you have seen a flattening of the price growth trend. And it went up 5 times rather than 10 times. Not all markets are rising. In China, Dalian is on your left. That over the last 2 years is a 25% real decline in land prices on sales from the local government in that city of Dalian. So prices do go down in China, they don't all go up. Dalian's the living proof. And there are a series of other markets. Wuhan I just put up as the example, where prices doubled. They didn't go up 5 times, they didn't go up 10 times, they doubled over the course of our index, and they flattened out also. So there's a lot of variation. Beijing's, if I put up, by the way, if we put up Shanghai, Shenzhen, they would be booming still in terms of their land markets. The interior markets would be flat to starting to decline, and every now and then you see a fairly major market like Dalian in obvious distress already. So that's what's happening. The most foreboding thing I see about the Chinese market is quantities. They're falling. This is just a count of the land sales to private developers in those 35 markets. And what you see is they're down roughly 50 to 60%, and they've stayed down now for 5 or 6 quarters. This is not just a temporary blip. And what this says is, remember, this is China, this is not Houston, which has no zoning rules, and builders can build whenever they want in Houston, Texas, in the southern part of the United States. In China, you got to buy the land from the local government to put up a building. You can't just put up a building because you feel like it at some point. And the fact that they've been buying less land, the total land sales are equivalent to what they were at the depth of the global financial crisis before the stimulus period in China. That tells me there's going to be less building down the road because they're just not amassing the land. And the reason is current inventories are increasing in China. President Xi indeed had a sentence or two in a speech 2 days ago when I was in Beijing talking about the inventories, that we needed to do something about them. Now, I'm not quite sure how that's going to play out, but that sounds like somebody's going to buy them. But who knows what they're going to do. But we see a slowing in transactions volume in the land market. And quantities lead prices in housing. This is the U.S. series on, this is home sales, home prices. That's just the FHFA index you saw earlier. Quantities peak about 12 to 18 months before prices in the U.S. on the downside and the upside. The same thing's going to happen in China. I believe there are strong economic reasons why quantities would change first. You're seeing them drop now. I think it's a sign of price weakness. But again, I don't think it's a sign of generic price weakness. I sense no weakness in the Tier 1 cities. Demand is still growing. They're not oversupplied. But in other markets, not Tier 4, Dalian is not a Tier 4 city. There's some fairly major markets that are in distress. And what are those markets in China? They're the markets heavy with industries that Chinese policy is no longer supporting. So if you're in a city that's oversupplied, that has a lot of shipbuilding, a lot of steel and the like, Chinese government, at least as I interpreted this, has basically signaled we're no longer going to subsidize those industries. We understand there's excess capacity. We're going to let them shrink a bit. If that market is also oversupplied, that's a recipe for price drops, and that's what I think is going to happen. Now, my last couple of points are just price to income ratios. Again, they're very high by Western standards, but again, they make sense if you believe income growth is going to be high. But remember, that's where the risk is if income growth doesn't materialize, housing becomes unaffordable in these cities. This is the price to rent ratio. Again, the blue line is Beijing. That's just a stunning number, above 50. Again, that's high by global standards. But again, it can make sense. It doesn't mean the market's going to collapse. it can make sense if you believe prices will keep going up. But what it says is Beijing's very risky. Small changes downward in price growth expectations can lead to very big changes in prices in that market. That's just, again, I'm not going to bore you with the math, but that's how it works out. So concluding thoughts, that's how I see China. Concluding thoughts, I think prudent regulations in order here. Clearly, we should have had it in the U.S. I think we went into gory detail with Dodd-Frank and moved away from much more simpler, prudent regulation. I hope my friends in China go in a different direction and try much more simpler, prudent, macro prudential rules. I would encourage, Singapore to do something similar. Sort of overkill won't work. Equity's the key to absorbing downturns everywhere and always. And it's true at the household level, it's true at the firm level, and it's true at the government level. So I think what the government needs to do is to ensure that there's enough regulation, but understand the context in which you're operating. In the US case, it was way more complex and way more systemic than just a problem of excesses in the subprime sector. Our growth, our housing boom and our housing bust occurred amongst a big over-leveraging that's taken us 7 to 8 years to work out of. What that means is credit quality and the like are legitimate issues for regulation, particularly in the US where home ownership was becoming more widespread. In China, the good news is they have equity at the household level. Their financial system is opaque to me. Many of you will know it better than I do, but I would hope they have enough equity. The government has enough reserves to deal with the problem. The key risk in China, I really think, have to do with deteriorating trend growth. The genesis of almost all downturns in real estate, whether housing or commercial real estate, are started with slowing economic growth. In other words, builders are building for a high trend growth rate, and then you get a lower trend growth rate. You don't even need a decline, you just need a lower trend growth rate, and you have a miss. That is exactly what has happened in China. Rather than 10, they thought they were getting 7.5, now they say they're going to get 6.5, and who knows, maybe they get 4 to 5. That's a hard thing to figure out, but that's the genesis of an overbuilding problem right there. And then you have to worry about the fact that you're relying on high income growth and high growth expectations to justify the very high price levels. Last but not least, worry about supply and demand fundamentals. The worst problems in China are going to occur in cities where there's oversupply. When you get a negative shock to the economy amidst an oversupply of a durable good like real estate, you get price falls. And again, I think that means if that becomes systemically risky, if you think it threatens your financial system, I think it's entirely prudent for the government to try to regulate that. But again, my thought would be they should regulate in a simple way, focusing on equity and not trying to sort of micromanage the way the Chinese did the stock market, the way we've done our banking system in the US. I do not think they're going to be very effective regulations, but I do think there's a role for simple ones. And with that, I'll turn it over to you. Thank you all for listening.
Thank you, Professor. May I now invite Dr. Sekera on stage to join Professor Joko to moderate the next segment. Before handing the time over to Dr. Sekera, a gentle reminder to ladies and gentlemen that during the Q&A session later, please do state your name and the organization before asking your question or making any statement. Please also raise your hand before you speak so that our staff can assist you with microphones. Thank you.
Thank you. Now, I think you will agree with me that Joe has given us a very insightful look into both the US and the Chinese markets, and I'm sure that it has stimulated a lot of interest in everyone, and you have particular questions that you would like to ask. Please feel free to do so, and I'd like to open up the floor to some questions now. Please raise your hand if you have a question, and as MT said, please tell us where you're from and your name. Well, let me just start the ball rolling by asking the first question, and please feel free to add in after that. Now, Joe, it's when you look at the home ownership chart that you showed us earlier, it suggested that currently the home ownership in the US is about 63%, and that's actually fallen from around 69% back in the 2004 Q1. Do you see the home ownership rate stabilizing, or do you expect to see it go up a little further as the economy starts picking up, employment is looking quite healthy now? That's the first part of the question. Second is, in light of the perception that there could be an interest rate hike in December, do you think that that's going to have some impact on home ownership rates?
Okay, so no, so I need to do something. Okay, trade. Question number one was, what's going on with the U.S. home ownership rate? It continues to drop slightly in the United States. I think it will continue to do so. What that means is we're getting more renters for a couple of reasons. Number one is the previous home ownership rate in the boom was inflated by this leverage cycle we went through, and that's not coming back. So, John, I see zero chance we're going back to 68, 69%. It's not going to happen. That was a blip in history. There's no reason to expect it to happen. Why is it staying down? And I think, if I had to guess, you should never do this when you're being taped. I think it's going to fall to 62%, a little bit lower, maybe 61. And remember, every percentage point is 1.2 million households, so it's a lot of people. Why? Three reasons, really. One of them is demographic. We have a big cohort of young people under age 35 in the U.S. They're the follow-on to the baby boom. They're another cycle. There are 28 million of those folks in the U.S. They are delaying marriage and they're delaying fertility. They're not having kids. They tend to be living in central cities. There is a boom in urban areas, urban cores of the United States, and it's being driven by young singles under age 35. And that trend is going to continue, in my view, and that means they'll ultimately become homeowners, but they delay it, which allows the rate to fall slightly. Number two is the banks, even though we have what I consider inappropriately high leverage loan programs in the US, the banks are not financing. The reason is they were fined to the tune of many billions of dollars after issuing similar loans in the last cycle. So even though the government has brought back these loan programs, the banks won't issue them because they don't believe that they won't be fined again if there are defaults. So the mortgage market is not as liquid as you think by just reading the press in general. And the third is, I think, psychological. We saw the greatest housing collapse since the Great Recession in the United States. The psychological belief in the previous boom that housing was the road to riches, it's no longer there. It's gone in the United States. I believe it'll come back eventually, but temporarily it's gone. And I think it depresses the homeownership rate, even though you're exactly right. Job growth is real, and I think quite sustainable in the U.S., and one would expect that to raise the homeownership rate. I think these countervailing forces will at least countervail and maybe slightly allow it to fall further. So that's number one. I don't believe the homeownership rate is reverting back up, which means if you own apartments, you got a lot of demand and you like being an apartment owner, as long as they're not overbuilding in your market. So that's the good news to the drop in the homeownership rate. On interest rates, gosh, I wish I knew what the Fed was going to do. I do. So here's what I suspect, but take it with a grain of salt because I don't think the Fed knows what they're going to do. I believe they're going to raise rates in December at the next meeting, which is in the middle of December. I believe they're going to raise rates by a very small amount, maybe 25 points. Which in terms of affecting mortgage rates, it's not going to be a big deal. Quite frankly, it's priced in already to the curve. So if you were to borrow last week, I think it's already priced in and won't generate a big shift. I also believe the Fed will announce a very slow glide path to future rate increases. And given my view on how weak growth is in the rest of the world, particularly in Europe, but slowing growth in China and the like, I don't see much impetus for significant rate hikes. So I don't think it's going to have a big effect on the property market in the US. I do believe even modest rate hike increases are going to have much bigger effects on emerging markets. So I would not feel the same way about Brazil, Turkey, countries like that. Emerging markets, particularly that have dollar-denominated debt. I think you could see big capital outflows and real distress in those markets. But in my country, in the US, I think the rise is going to be, to a large extent, a non-event. It's already priced in. Yeah, Yang
My name is Yong Henteng. I'm from NUS Institute of Real Estate Studies. There's a common perception in the past 10 years in China, Asia property market experienced tremendous boom. It caused the golden period, profit is rich. Now people believe it's entered into a silver period. Profit margin became narrower. And then in your presentation, you show the US market pick up. And then there's a phenomenon, so-called capital outflow. A lot of institutions, including the individual household, they try to pull their cash to invest in the US market. I have many Chinese students. They say, I know many rich people. Professor, can you guide me to invest in the US housing market? I have two questions. First question is, what's the implication to the destination countries? Like there's a lot of Asian money or Chinese money or Singapore money go into the US housing market will cause another bubble or not? The second question is, do you have any advice to, especially to those individual household investors, they try to become millionaire invest in the US housing market?
Okay, I get asked the same question by my Chinese students, and I'll give you my short answer, which is I don't give that type of advice. And the Wharton School prefers we don't do that with our students. So I think, Yang, there are sub-markets of housing in the United States where foreign investors in general, Chinese but other investors, particularly the Middle East and the like, where the US is clearly a haven country. If you want to buy housing in Manhattan, it has been bid up by foreign investors, broadly speaking, not just Chinese, and it's had a very big impact, because that's a market without a lot of new construction compared to the size of the market. So supply's restricted. People want to park their money, some of it political risk money, some of it just they want to economically diversify, which I think is a quite rational strategy if you're a Chinese nationalist, to diversify out of yuan-based investments. Makes perfect sense to me. But I don't think it's a big deal in the overall housing market. It is in Orange County housing markets where you can find entire neighborhoods bought up by Chinese nationals. Orange County's in Southern California, parts of Manhattan and the like, complexes are dominated by Chinese investors and the like, and other foreign nationals too. But if you go to Philadelphia, if you go to Chicago, you go to many other markets in the US, it's just not that big a deal. I think the bigger impact for foreign capital flows, particularly from institutions, is in the commercial property markets. It's huge capital flows in the US. So this is buying office, industrial, warehouse, you name it, retail and the like. Those flows are very, very large, and they are now widespread. The last couple of years, they were only in our gateway coastal markets, Boston, New York, Washington, Seattle, San Francisco, Los Angeles, maybe San Diego. They've spread to the interior of the United States, and they have been affecting prices. So I think that's a really big phenomenon. And if it reversed itself, I think you would see price reversals in those markets. I don't view it as big an issue except in isolated housing submarkets. It's a much more important phenomenon in commercial income producing real estate.
Okay, next question, please. Yes, over there, please.
Hello, I'm Chen Zhen. I'm from MS. My question is that since year 2010, both Singapore and Hong Kong had a series of property cooling measures to cool the hot property markets. Do you think that the government should set a policy, so-called policy target property price? I mean, if the government were to set the cooling measures, what kind of things are the right not to do?
So one, I can't comment on Singapore policy because I don't study it. But I can answer the question on, do I think it's wise for any government to think it knows the right price level? Not really. I just don't see how you do that. It takes markets a long time to figure out what the right price is. People take risks. So I don't think the government has any insights. I suspect what motivates the government, and quite legitimately, are certain political issues having to do with affordability. There's nothing wrong with a government caring about housing affordability, which I suspect is a big motivation for your government. That's a legitimate issue, but I don't think it's wise for governments to somehow think they know the right price level for an asset. It's just, like you said, markets have a hard time figuring this out. I don't know how governments do. But yeah, I do think macro-prudential, I would prefer governments not to try to target prices, but to try to enact policies that they think are legitimate and ensure that whoever is investing in the property sector has enough equity to make it out of a downturn if they're going to be systemically risky. By the way, if they're not going to be systemically risky like the U.S. home builders and they go broke, like I said, many of them were I direct a real estate center. It's not like I was happy when these guys went broke. Many of them were friends, some donors, but they're not systemically risky to the U.S. I see no reason for the U.S. government to try to intervene to either protect them or bail them out in general. But that's a long-winded answer of, I'm skeptical of price targets, and my last example of that is that I think it led the China, thinking about a price target in stocks led the Chinese government to what I think was counterproductive intervention in that market. I think it tends to get you more in trouble than it does otherwise. That said, if I have in the US, I think it's legitimate for the Federal Reserve to question whether the 6 million added homeowners from the higher home ownership rate, are they actually financially able to own a house over the long term? Or are these people who get laid off a lot and are likely to default? I think that is an entirely legitimate thing for a government to investigate and indeed regulate.
Next question. Please.
Good afternoon, professors. My name is Ian. I'm from Savannah, Jurong. My question is more to the non-residential market of the income yielding, recurring income yield-based type of market. In your study in China, what's your take on what's the level of maturity of this market, and where's the growing trend in view of what's going on?
So, I don't do nearly as much research on non-residential in China. So I don't have many insightful comments there. Housing's clearly very, very different. And again, I think we need to ask Dr. Seek and the people at GIC and others who look at these markets. But it'll be just like other countries around the world. It'll vary by market. If they overbuilt in a place, prices are going to fall. There's still a lot of job growth I think it just depends on the city. But that said, I see no evidence bankruptcies in commercial real estate would threaten the financial system of China, which means if I'm the financial regulator, I don't lose sleep, or even if there's a downturn in that sector, because it doesn't look to me like there's enough leverage to threaten the balance sheet of the banking system in general. So what's going to happen in the individual markets, I don't know. I think the same thing in housing. In the markets where they have weak industries which aren't going to grow in the future, I'd expect trouble not just in housing in those markets, but in commercial real estate in those markets. And I'd expect real trouble if downturns occur amidst an oversupply. And that would apply to office, not just housing. I think it's the same thought process.
Next question.
Dr. C, you want?
No.
And then I'll trade.
Let me pick on the point you made earlier that a lot of massive amount of money pouring into commercial real estate in America, and that there's so much that do you get a sense that they're now getting very expensive? And is it likely that the new Chinese investors are going to back the Japanese investors in the 1980s?
Yeah, I do worry about that. I think nothing is cheap in property in the United States. That's been true of the gateway coastal markets for at least 24 months. That doesn't mean I think Manhattan condos are going to fall anytime soon, but they're very, very risky at these prices, and I personally wouldn't advise you or anyone else to invest at these prices. But what worries me is that this price boom has spread to Philadelphia. So that Philadelphia is where the University of Pennsylvania's Wharton School is, where I teach. We are a secondary market, between Washington and New York, not a prime market for foreign institutional investment. We have foreign institutional investors buying up office regularly in Philadelphia. No, I'm not kidding. So yeah, I'm actually worried. I think that's the biggest property risk in the U.S. is not our gateway coastal markets, which are, I think, more, at least fully priced. It's the Philadelphias of the country which have seen recent booms in prices. I think that's an issue where I would go, don't do it. That one, even on tape. Don't do that. Oh, absolutely. It's a global phenomenon. But I think the phenomenon, here's the thing. I look at that investing and I question its rationality, and then I talk to some of the investors as they come through Wharton, and some of it is pure political risk. And imagine you're in the Middle East. It's a small price. Look at what's happening in the Middle East. So you overpay a bit. Is that a bad thing compared to the political risk if you keep your money? In other words, there's a lot of flight capital that isn't economically motivated that I think explains some of this, and it may not be irrational. I think they're going to get very poor returns, but they may be perfectly satisfied with them given the political risk in their own country.
Well, you see a lot of institutional money, right, moving these assets. And
We do.
yeah, these are not seriously political flight money, but these are
But you might
really,
consider,
you would like to think that it's a considered asset allocation to spread risk around the world, right?
yeah, the other explanation I get is, well, at least real estate's not as badly overpriced as the bond market, right?
Fair enough.
There you go. So it's all relative. They have to put their money somewhere. So, Dr. Seek, headed up an organization that had both a liability side and an asset side to a balance sheet. And if you're running a big insurance company, you have liabilities. And you can't keep your money in cash. I think that's what motivates them, which is the cash yields are zero globally now, almost. Not in China, but they're really low. And they're searching, and But I agree with you. I think we're going to see a bunch of people disappointed by returns.
So do you think the main culprit is very low interest rate?
Yeah, I think there's massive yield searching. Now, I understand why our Fed did what it did. I understand why the ECB is doing what it's doing. And I presume the Chinese Monetary Authority is going to continue a series of loosening measures in that country. So I know why they did it, but yes, Dr. Seek, I think it generates some very odd behavior. And I think there's been a lot of yield seeking by institutions who have known liability streams they cannot